Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
Hey, and welcome. This is the Investor Coaching Show. I am Paul Winkler. Talking about the news of the week regarding the financial world. Things that are being talked about out there. And probably, one of the things is trying to get this stuff into context is really a big deal. And, what I mean by that is you'll hear news and it's hard to put it in context. There's a whole thing that, when we look out at the media, you hear me talk about this all the time, today's show too. How the media tends to put things in a very negative light because it attracts attention. And it's, disproportionately the United States, from what we see in how things are just so negative and so scary. And it's just part of our survival instinct. We are attracted to these types of things. But, there have been a lot of people talking about inflation recently, talking about how the dollar depreciating in value, and they may say instead of it depreciating in value, instead of inflation, it's a lot more impactful to say it's crashing, right? That's going to get your attention a lot faster than it's depreciating in value. We don't want wimpy words. We want something that's really, really going to scare you because that'll get your attention, right? And one of the things I talk about is in regards to inflation. I talk about how equity stocks have historically protected us from inflation. And the idea that we own stocks because companies raise prices and you own the companies that are raising prices. But one of the things that people get confused about is what if you have inflation and the information comes out that there's inflation, but in the short run, that stocks go down in value? What's going on there? If they're supposed to protect us from inflation, why is it that sometimes that happens? That stocks go down. So there's a segment on CNBC that I thought I'd play for you. I thought it was really good regarding this. Check this out regarding this.
Look, I think Costco also this is Costco's time in that they're eating a lot of margin in order to bring in customers. They do everything on a volume basis. I think Costco is a terrific investment. If that's what their number is, I like it even more because what they're doing is saying this is the moment when people are trading up to Kirkland brand. We have promised in an inflationary world to hold the line. So when you hear that they don't have comps, it's more from the good comps. It's more from the fact that they're not raising price. They're keeping prices low, and they're going to go after all the people who raise price. Maybe there's a weather issue, could be a gasoline issue. But when you speak to Costco, they're adamant. Look, we're not going to take price.
Well, I wouldn't necessarily say, hey, let's go out and buy their stock right now because we're not going to raise price because...
They're about five. They're not about price. Right. Everybody, you go Kroger's raising price. Sure. Costco says, we'll take share from them. Sure. Right.
Yeah, so, Kroger's raising prices. So in essence, you might not have necessarily a Costco near you in this particular example, and it may be too far to drive, but they're raising prices. Some other companies are raising prices. And basically what he's saying here is this, is that companies, as I've said many times, when you have inflation, you might actually react to it a little bit differently than your competitors do. Some companies may raise prices. Maybe they're going to get a little bit fancy. Maybe they're going to change the volume in their goods that they're offering. Maybe they have smaller boxes, so it's in essence, you get less product for the same price or whatever. But here's the point. When a company holds the line, what is going to happen if their costs remain the same? Well, of course, their earnings are going to be hurt by it. So that's what he was talking about, comps. If you look at that compared to other companies, what are they looking like? What are their comps? What are their comparables to other companies as far as profitability goes? And they're not looking so good. Now, he's a stock picker from way back, and I've done all kinds of studies regarding, talked about studies regarding, if you had actually chosen the stocks that he told people to buy, that your returns, pretty abysmal results. Kellogg School of Management found that you'd do better selling the stocks that he told people to buy. So just ignore that part. I just want you to get the idea, the concept here is that when companies hold the line, what are they doing? Well, basically what Kramer pointed out is that they are trying to take share from other companies. So in essence, you might not raise prices right away, and you may try to hold out and take a hit to profitability short run and do it purposefully so that when things come back, or when you feel like you can raise prices again, now you have the share. You have a lot of the customers. Now they've gotten used to going to your store versus your competitor's store. And that's the idea behind it, is if I can get people just accustomed to coming over to our store because our prices have stayed low, then they've gotten into habits. And we know what people do with habits, right? They're hard to break. And once I've gotten a habit to going to one place versus another for my goods and services, I'm probably not going to break that even when the prices do go back up. So what'll happen is this. I mean, look back to the 1970s. There were companies that had all different kinds of companies that sold cars. And those car prices for many companies, stayed the same for a while. And then all of a sudden you got a competitor, they start to raise their price. But you got one that's holding out. They're keeping their price low because they're trying to take share from their competitors. And then eventually what happens is they have to raise prices. Maybe they raise prices for service in their dealerships or whatever. But they find ways to get money back. And then what happens is if you look back through the 1970s, through the 1980s, you will see that the returns for stocks were significantly higher than historically normal. Why? Because of inflation. Now, at first they went down, though. This is one of the things you notice. If you look at 1973, 74, it was brutal. Went down in anticipation that we were going to have inflation, in anticipation of a stagnant economy, in anticipation of maybe energy issues or whatever. What happened is stock prices went down, and that's the way stock markets work. They go down in anticipation that there are going to be problems ahead. And the big problem is going to be profitability. And so what you'll have is stocks will go down, and then all of a sudden companies are dealing with profitability issues. But why? I mean, there's supposed to be inflation. They're supposed to protect us. They're supposed to go up right in tandem with inflation. No, that's not the way it works. They don't go up right with inflation. Many times they'll go up, but then later on, if you looked at that period in the 1980s, interest rates were high, right? And you look at it, go, well, yeah, interest rates are high. Remember CDs paying, significantly high rates. But if you looked at stock returns, it was way, way in excess of what CDs or any fixed income investment was paying. Because CDs and fixed income investments have never been a good protector against inflation. You may see higher interest rates right now because inflation, and you say, well, the returns on equities, over like last year and the year before, it wasn't really that high. I think I'll go over and shift over to CDs and fixing. And people forget that over the past 10, 15, 20 years, interest rates have been abysmal. I mean, really, really bad. And you look at it, yeah, recently they're high. Well, the same thing happened in the 1980s. And in that interest rates were much, much lower before that. Then you got to the 1980s and people did the same exact thing. They started bailing. Matter of fact, there was the death of equities. Business Week had an article, The Death of Equities. And it was how investors were just bailing on stock markets. They were moving away. They had found other things, collectibles and other things that were much more attractive to them. And then they moved away from equities. And then you had a 5-fold increase in the S&P 500, an 8-fold increase in the Europe, Australia, Far East Index. It was like an 11-fold increase in U.S. smaller companies over that period of time. And what they had done is they missed it. And this is what investors do time and time again. They miss it. And it's really important not to miss it, because if you're sitting there in fixed income investments, and I've used these numbers before, go back to 1926, $1 in treasury bills grows to like $22 from 1926 to the end of 2022. And then you say, well, what did the same dollar grow to in, let's say, large U.S. stocks? So it's like 14,000. I mean, there's a big difference between them, right? $22, 14,000. Who's counting? And if you look at small value companies, it's it's above 100,000 for U.S. small value companies, according using the Fama French research index. But if you look at that and go, wow, there's a huge difference between those things. And, recognizing, though, that this is not an in tandem thing, it's really important to have proper expectations when it comes to investing. If I expect a certain thing is going to happen, like let's say that stocks will go up as soon as inflation kicks in, then you end up, and when it doesn't happen, you go, well, wait a minute, the old paradigm doesn't work anymore. Just throw it away. Remember, there was an article, I don't know if I talked about it last week or the week before, but it was something about annuities can protect against inflation. I'm like, yeah, good luck with that. They were talking about having these indexing features in annuities where they index to inflation, not indexed annuities, but indexing features where the annuity goes up based on the inflation rate. I'm laughing going, yeah, right. Have you ever seen the payouts on those annuities? Because they're investing in fixed income investments. That's what insurance companies mainly do. They invest in bonds and short-term fixed income investments. They can't protect against inflation because that investment, they're just an intermediary between you and where your money gets invested. You give your money to an insurance company. The insurance company takes and invests that money into fixed income investments primarily, and then some a little bit of real estate. But if you look at that, you say, "Wow, okay, how can they give me protection against inflation when they themselves don't invest in things because of their mandate as an insurance company, how they have to invest if they don't invest in things that protect against inflation?" And the answer is an obvious, they can't. And the reality of it is that the best way to make a ton of money with annuities is to be the person selling them. But that's another story. So if we look at equities, we look at stocks, and we look at markets, and we go, okay, so, inflation, protection, how does this happen? I just thought that was a really good example to bring to your attention, regarding how this stuff works. As a matter of fact, Dan Mandis actually sent me something, and, I thought, hey, this would probably be a good thing to talk about. It was an article about economics expert issues dire warning on serious threat faced by U.S. dollar. It's inevitable. Now, number one, anytime I see stuff like that, I go, economics expert. Who is this expert? What makes them an expert? Why would they know better than anybody else how markets should be affected by things? Well, the answer is if you look at the data on it, you see that as I've said before, 93% of the experts, the professionals, can't beat what the market's done over the past 15 years. The 7% that did, it's pretty much what we know from research is blind random luck. We look at small cap stocks, it's 97% underperform. 3% outperform. That's really great. Yeah, wow. But, you see this economics expert issues a dire warning. Now, number one, why is he going to tell you? What's in it for him to tell you that there's something going on with the dollar? Now, if you look at the dollar, it has, against many currencies so far this year, it has already gone down versus other currencies like the euro and like the yen. So it's already done it. But then you throw on top of it, and he was asking me about this, as in China and Russia, throwing that on top of it. He says, I knew about China and Russia and blah, 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 because that's part of the article. And this gets really complex. But one of the things they're talking about is, in the article, is, China and Russia coming up with a currency that has a gold standard behind it, blah, blah, blah. And one of the things I pointed out to Dan is that we walked away from the gold standard for a lot of reasons. And one of the things that would happen is other countries would go and redeem dollars for gold. So we had an outflow of gold because our dollar was tied to the gold. And that was really bad. And it's not unlike, though, what happened in the 1800s. In the 1800s, we would have people that were a little bit panicky, they were a little bit worried, and they would turn in their dollars for gold. And then all of a sudden the money supply would go down, the number of dollars floating around, and nobody goes around to the grocery store with, scrapings of gold to buy groceries. It's just not practical. So what ended up happening is people would go in and turn in their dollars for gold, and they didn't have dollars, so they wouldn't spend because they didn't have the dollars to spend. They had the gold. Remember, they were nervous. Then all of a sudden, what happened is then you had people turning in their gold for dollars when they felt euphoric. and they were excited. And what would happen is you'd have these hyper expansions and hyper contractions in the economy, which was really, really bad. And yet these booms and the depressions were really devastating. And, the thing that they've been talking about for quite a while is this whole idea of China and their currency. And if you look at, their currency, it's likely to be reserve currency. Seriously? Nobody trusts that the government, because it's a communist government, will do what they say they will do. And, to the credit of the writer of this article, they pointed that out. That is the case. Nobody trusts them. Who trusts Russia? Who trusts China? And you've got to be very trusting of the currency because, the country that actually puts it out there, if they can manipulate it, they can ruin you pretty quickly. All they have to do is devalue it and you're sunk. Now, if we look at, and I said the short version for investors that will always trade stocks and they're going to be traded at a multiple of whatever currency that they're issued in. So if we're looking at US dollars and US stocks, the stocks are traded at a multiple of their earnings. And historically for the S&P 500, it's right around the neighborhood of 16. U.S. large stocks sell for about 16 times earnings. And if all of a sudden we, instead of using $1, and it's not $16 to $1 of earnings, and we change it to clams, that it's going to be 16 clams to every 1 clam of earnings. And if all of a sudden we have, let's say that the weakening of the dollar occurs, like it did, so far as I'm, and who knows what's going to happen the rest of the year. But so far, year to date, the dollar has weakened. In other words, it takes more dollars, and it's not even more dollars, it's more pennies, really. It's a small increase because you don't see huge swings usually. But what happened is that the dollar weakened, and it takes more of our physical dollars, if you're an American, to buy things from international markets. And if those things in international markets are companies, then you'll see that their stock markets will go up versus U.S. stock markets, that they'll become more valuable because we are buying them using our dollars. And so hence what happens is if we have a weakening or a significant devaluation of the dollar, let's say, then I'm glad I've got international companies and glad I've got tens of thousands of them. It's a really good thing. That's why it's so critical to not forget about international diversification, as so many times people do. And, you'll have this period of time. And people, this isn't just people forgetting about international. When I got in this business, U.S. stocks had been weak for 2 decades. And people were walking away from U.S. stocks. And they were saying, Paul, don't bother putting any of your clients in U.S. stocks. Just put them in international. Why? Because you had 2 decades, literally, where international had done better. And, the final thing I said to Dan, I says, anxiety is a funny thing. We fear the future. Then we come up with all kinds of possible scenarios that cause us great distress. And in an attempt to protect ourselves, we actually bring on the calamity we're trying to avoid. And, I talked about that show that I'd done on conspiracies and the fears people had over the past 20 years. And how exhausting it was for me to talk people off the ledge over and over and over again. And, that so far year to date, weakening dollar be part of it. International has done better than U.S. Will it continue? Who knows? But diversification is the most rational way to protect ourselves because you just don't know what's going to happen in the future. And I think far too many people are far too undiversified. They just really, and they say, well, you need to pull your money out and just kind of wait and see what's going to happen, and then markets recover, and it's too late to get back in. Or they go and stick their money in some insurance company that pays a ton of commissions to the advisor, and it's all, they're all focused on fixed income, and then they can't get out because they got back end surrender penalties. And, you got all of these issues that investors are up against because they're trying to figure out what's going to happen in the future to protect themselves, and they literally put themselves in the danger that they are trying to avoid. And as best I can, I'm going to educate till the cows come home so that you don't put yourself in that position. All right, back here. It's Investor Coaching Show. Paul Winkler. So I often talk about diversification and the importance of it and the various areas of the market that you want to make sure that you have exposure to. Like large U.S. companies are great. A lot of people say, just index the portfolio. Just put everything in a total market index fund. And you're way overweighted in one area of the market. You don't realize it. Because the name says total market index fund. I mean, how can you go wrong there? It has the total market. Not exactly. And you see it a lot in these target date funds that I talk about. So you might go, well, I'll put everything in the S&P 500. There's a 500 biggest companies. That's a lot of diversification. And one guy say to me, well, there are a lot of exposure to international markets in the S&P 500. And I was like, no, it's all denominated in dollars. If the dollar weakens, you don't have that. Good luck with that one. But, sometimes it's hard to convince people. Person convinced against their will is of the same opinion still, right? So then you have value companies, and, those are different areas of the markets. And you've got smaller companies. Smaller companies are going to just operate differently historically. There's something called the goalpost effect, where we see that very, very big companies, very small companies historically have operated very differently from each other. Where they'll have really either high returns or low returns in the same period of time. Like small companies may have very high returns short run, and the same period of time that large companies be low, and vice versa. And that's why you diversify that way. But check this out right here regarding the S&P 500 recently. This is interesting.
The Apollo has a good chart today.
Wasn't that
looking
interesting?
At the year-to-date rally,
Holy cow.
almost entirely due to 20 companies.
It's like the old days?
We know which ones they are. Is it a problem or not?
Look, I think that there's nothing you can do. When you have a slowdown, a credit slowdown, you tend to want to buy companies that don't need credit. None of those needs credit. The issue with that, again, as we were talking about, is what Mike Wilson said, which is if you're going to invest in tech because it doesn't need credit, you forget that you need revenue growth and you need earnings growth, you need profitable growth. So this works in theory, but in 2 weeks, it'll be sorely tested by actual numbers. And you're not going to be able to say, you know what, I'm so glad I bought Microsoft. I'm just picking myself up. You don't have to record, but so glad I bought Microsoft because of the balance sheet. Oh, darn it, it's currency. Oh, darn it, slow down. Oh, geez, I thought Bing was coming back. So you have to be honest with yourself and recognize that earnings season, it's all up for grabs.
Yeah, so you listen to that and you go, wow, yeah. You might look at the S&P and go, well, look at the return in the short run. And who knows? I mean, it could be 2 days later and it's a totally different deal. But if you look at, and I talked about this some recently, I think on the show, or I can't remember. No, it wasn't on Matt. It wasn't when I was talking to Matt. But it was just looking at the S&P and how dominated that index is by really just two companies. So we look at that and go, well, what's going on there? And what's going on is, remember what you're buying when you buy companies. You're buying the rights to the earnings in those companies. And one of the things that we have in earnings is interest payments. So if you look at it and say, okay, when I'm buying a company, buying a stock, the company sells something. So that's at the top, sales. And then you have taken out of that cost of goods sold. And then the next thing you have taken out is operating expenses, cost of goods sold, the things that go into the making of the product that you make, whether it be steel, whether it be software, whether it be, computer chips or whatever. Whatever it is that you make, you're going to have a cost if you manufacture something for the goods or the things that are going to go into the product that you're producing. Then you'll have operating expenses. So you'll have your employees, you got to pay them, And that's one of the big things right now is if employee wages are going up, that can hurt the revenue of the company because of the fact that they're going to have to pay those expenses out of the sales. Then you're going to have your interest. So if you've borrowed money, that interest is another expense that comes out of the earnings. And then you have taxes, of course. So what we're dealing with here is companies that need to borrow money are having to pay more more to borrow that money, which can hurt their earnings. Well, so what they're pointing out there in that segment is that some of these companies that don't have to borrow any money because they're flush with cash are benefiting because their earnings won't go down because they're not having to pay more interest to use other people's money. So hence what's happening is these companies have been rallying. And as a result, you're finding that indexes like the S&P 500 or the total market indexes are getting massively overweighted with just a few companies that didn't have to borrow a lot of money. Well, what does that spell out? That can spell out huge risk when those things turn around. And as Kramer well pointed out, all of a sudden you can have any number of things that come down the pike, new revenue numbers, new sales numbers, new, whatever numbers that come out, and they're just, you can literally go for days. You could have a situation where your products are no longer in demand. Maybe somebody comes out with a competing product. Maybe you all of a sudden have some kind of legislation against you, or you have some kind of a situation where you're being sued for something, or your CEO changes, or, you could have, taxes, maybe regulation comes and affects you that doesn't affect somebody else, or maybe regulation that came out is now just starting to affect you, or whatever. Or geopolitical issues. I mean, good grief, you could have any of those types of pieces of news that come out that affect your company or your group of companies disproportionately. And then all of a sudden, now you can't get out fast enough, or people can't get out of your stock fast enough, or your area of the market fast enough. And what happens is people typically do that. They myopically look at one little thing. Oh, interest rates are going up, therefore this company is more valuable. And that was the point that he was making right there. I pick on him a lot, but my wife's like, "Why do you listen? You pick on him all." I just pick on when he engages in stock picking and market timing. I think he has a really great handle on geopolitical, macro issues, as I told her the other day. I says, I love when he talks about macro issues, what's going on in international markets, what's going on in the big picture. But when you get into micro issues, how this company's going to be affected, that company's, that's when I just tune out and go, spare me. Nobody knows. It's a waste of time. But I think that is a key element to remember. Is don't look at one thing or a small thing, or when you see a news item, say, this is what the president's doing, this is what Congress is doing. Recognize that what anybody's doing or what is happening in a small area like that, and it can be a big deal, but the reality of it is there are thousands of factors that drive stock prices. To sit there and look at one thing is a bit short-sighted. It was like I was telling somebody the other day, I says, reminds me when I sold disability insurance a million years ago. People would come in and they say, hey, I want a disability policy. And I go, hey, here, we got the policy issued, but they put a rider on your knee. And they're like, oh man, my knee is bad. They put a rider on that. What if I'm disabled because my knee goes bad? I said, here's the reality of things. The reality is that your knee is the thing that you're watching the closest. You're taking care of it. You're doing what you feel like you need to do. You're exercising. You're getting, physical therapy or whatever you're doing. The thing is probably going to disable you is the thing you're not watching. It's probably going to be heart disease or cancer or diabetes or whatever. It's going to be something totally different that disables you. And that's the same thing with the stock market. You may be sitting there watching interest rates like crazy and go, how are interest rates going to affect? Well, that's what everybody's watching. You're not looking at anything that's really all that unique. And then all of a sudden, when something totally unrelated to interest rates changes, whatever you invested in based on interest rates comes crumbling down. Then you go, gee, what hit me? Well, I wonder. That's it. You were looking at all the wrong stuff. And you think you're looking at the right, and you were looking at something that did matter, but it wasn't the whole deal. So, hope that's a lesson out there for investors that try to move things around based on what they see going on around them. It's usually too little, too late when you go and you follow what's just gone on and make moves in your portfolio and creating all kinds of risk that you come later to regret.